Welcome back to the Pro Ticker Podcast, your Tuesday morning edition, covering major financial magazine headlines, everyone. We are jumping into a really deep dive today that it gets across everything, from major market stumbles driven by crypto chaos to the AI wars that are, believe it or not, threatening to raise the price of your next piece of tech, and even critical global policy battles that are literally sitting before the Supreme Court right now.
It is a dense stack of sources this week. It really is. We've pulled insights from, the CNBC Daily Open, Reuters, Bloomberg, and Yahoo Finance. We're really focusing on the reports that move markets, and our mission, as always, is clear. We need to pull out the absolute critical insights, the nuggets of knowledge you need to be truly well-informed this week and figure out what's actually driving the price action, not just, what's making noise.
And we absolutely have to start with the noise that turned into, well, real pain on Monday. U.S. indexes just snapped those 5-day winning streaks.
It did.
And the whole sell-off, according to CNBC, was largely, and I'm quoting here, tripped over by a sell-off in crypto. Bitcoin had its worst day since March. It dropped around 6% to trade below 86,000. It just feels like that risk-off sentiment came back with a vengeance.
It's the perfect anchor point for our discussion. We're going to structure this whole deep dive around three main themes that really stem from that volatility. So first, the crypto reality check. We'll look at these reckless retail bets versus some serious institutional adoption. Second, the AI engine's growing pains. Leadership shifts, supply chain crises, and the whole bubble debate. And finally, global policy battles. We're talking high-stakes litigation over tariffs and the latest from global central banks.
Okay, let's unpack this, starting with that crypto route. That chill started overseas, didn't it?
It did. The market saw Bitcoin and Ether just plunge 6% and 7% respectively right out of the gate on Monday. And the immediate global trigger, it was a weekend statement from the People's Bank of China warning about illegal digital currency activities. That really spooked the Asian markets and then just flowed west.
And we should say Bitcoin was already under pressure before this, right?
Oh, yeah, for weeks. It had already fallen roughly a third from its early October high of, $126,000 before this Monday morning drop.
But here's where it gets painful and really specific for the folks at home. While the big institutional story is bullish, the domestic news, particularly from Bloomberg, was all about the cautionary tale of these leveraged ETFs.
Ah, yes, the ones tied to MicroStrategy, or MSTR.
Exactly.
This is where that gap between, let's say, sophisticated trading and retail trading becomes a chasm. It really does. We're talking about products like MSTX, MSTU, MSTP. They're designed to double the daily returns of MicroStrategy's stock.
And MicroStrategy, for anyone who doesn't follow it closely, is basically the biggest public company proxy for Bitcoin exposure.
That's it. And the underlying shares, MSTR itself, fell 60% from their recent highs.
And the leveraged ETFs, they utterly collapsed. They plunged more than 80% this year.
80%.
To put that in perspective, out of over 4,700 products in the U.S. ETF market, these are among the 10 worst performers. That is just extreme capital destruction.
And what's fascinating here, and what you really need to understand about these leveraged products, is this concept of volatility decay.
Right.
It's not just that the stock went down. These instruments, they lose value simply because the market is volatile. If you imagine trying to catch a ball that bounces 50% up and then 50% down every single day, if you multiply that move daily, those compounding losses just chip away at your returns.
Even if the stock just goes sideways and ends up back where it started.
Exactly. They're designed for very short-term bets, not for holding in a choppy market like this.
That's such a crucial distinction. We even saw the internal strain on the company itself. Bloomberg reported that MicroStrategy's CEO had to create a $1.4 billion reserve.
From recent equity sales, right?
Yes, to cover payments and, crucially, to avoid being forced to sell any of their actual Bitcoin holdings. It just shows you the strain in that structure.
It highlights the massive, massive risk profile. Now let's contrast that implosion of retail leverage with the move we're seeing from huge institutions.
That's the irony, isn't it?
Perfect irony.
While these retail bets are just getting torched, major institutions are formally recommending crypto exposure. Bank of America's private bank, for instance, is now suggesting clients comfortable with volatility should allocate a modest 1% to 4% in regulated digital assets.
And this isn't an isolated event. This is a foundational shift.
Right.
We saw Morgan Stanley suggest 2% to 4% back in October. BlackRock is recommending 1% to 2%. And Fidelity suggests 2% to 5%, even pushing as high as 7.5% for younger investors.
And the key difference is the approach.
It's all about the approach: regulated vehicles, modest allocations, and diversification.
And it's not just recommendations, it's access. I saw reports in Yahoo Finance that Vanguard is starting to allow certain crypto ETFs on its platform this week, joining JP Morgan and Fidelity.
So that institutional narrative is all about thoughtful, diversified exposure.
Which is the exact opposite end of the risk spectrum from those collapsing leverage retail bets we were just talking about.
They're essentially saying, yes, this asset class is maturing and it has a role, but the way you access it must be prudent. It's validation, but it's very cautious validation.
That institutional shift is foundational. Okay, let's pivot from finance to the engine room of the economy right now, which is AI. We saw a major leadership shakeup at Apple that suggests they might be, well, feeling the heat.
That's right. Apple announced that John Giandrea, their head of AI since 2018, is stepping down to retire next spring. And this comes amid an expert consensus reported by CNBC that Apple has indeed fallen behind its peers since that, generative AI explosion in 2022.
And the person replacing him, Amar Subramanya, he's an AI researcher coming from Microsoft. And before that, Google's DeepMind unit. That is a very strategic hire.
It has to be.
It's all happening while their own Apple Intelligence Suite has faced criticism, and the new Siri has already been delayed until 2026.
It signals a necessary pivot. They're looking for external expertise. Meanwhile, NVIDIA, they just continue to diversify their dominance.
Wow.
CNBC highlighted their strategic $2 billion stake in a company called Synopsys.
For a partnership to speed up AI engineering and design, right? This is a brilliant business-to-business move.
Exactly.
Jim Cramer made a great point about this. He called it a move for substance, not for show, unlike some of the consumer chat apps. He thinks Wall Street loves this B2B strategy because it suggests deep fundamental growth.
And that ties directly into Cramer's broader observation that the whole AI trade is now breaking up. It's not just a rising tide lifting all boats anymore.
So what does he mean by breaking up?
Well, we're seeing stocks affiliated with Alphabet's Gemini getting a lift, like Broadcom. But the OpenAI complex, that's NVIDIA, Oracle, Microsoft, it's weathering losses. And that's due to growing concerns over OpenAI's truly massive spending commitments.
Right, and the pressure that puts on their cloud providers. I saw Oracle shares have dropped significantly since their highs in September.
Exactly.
So here's where the AI boom directly impacts you, the consumer. This sheer scale of this infrastructure build-out, it's creating these unintended consequences for the supply chain. And it's set to raise the price of consumer electronics across the board.
This is a major structural shift. Some analysis I saw from CNBC actually calls it a seismic shift. The hundreds of billions being poured into building AI data centers, it's clogging the supply chain for advanced memory chips, specifically DRAM.
Dynamic random access memory. The stuff in everything from servers to laptops.
Correct. But the real kicker is NVIDIA's shift in what kind of memory they're buying.
They're moving toward low-power double data rate memory, or LPDDR. So why does that matter to someone buying a new phone next year?
Because LPDDR is the specialized, high-performance memory traditionally reserved for high-end consumer electronics. Think Samsung and Apple's top-tier phones and computers.
So a new, massive buyer just stepped into a very small pool.
A massive, insatiable buyer. NVIDIA, for its AI accelerators, has jumped into a specialized supply pool that was traditionally just for consumer makers. The imbalance is severe.
How severe are we talking?
Well, analysts are citing demand-supply imbalance levels hitting 3%, which is really significant in this industry. Counterpoint Research is projecting that memory prices will rise 30% in the fourth quarter of this year.
30%.
And another 20% in early 2026.
Wow. And since DRAM and storage make up a huge chunk of a phone's cost.
A big chunk, 10 to 25% of the bill of materials. So Bain & Company estimates that overall consumer electronics prices could climb by 5 to 10% in the near future. It's a direct tax on consumers driven by the AI boom.
So AI, the thing that promises to make everything more efficient, is literally making everything else more expensive. What a contradiction. Shifting gears, we have to touch on the biggest valuation debate right now. Is this AI rally a bubble, or is it fundamentally sound?
The mood is definitely split. And the warnings are serious. The European Central Bank, in its Financial Stability Review, warned that high AI valuations are overwhelmingly driven by fear of missing out.
FOMO.
Exactly, FOMO. And not purely reflecting robust earnings yet. Yeah. They also noted the intense market concentration among a small group of U.S. tech giants.
But then you have the other side, and it's firmly represented by SoftBank's Masayoshi Son. He is betting the farm on AI.
He sold SoftBank's entire NVIDIA stake for $5.8 billion to fund his huge bet on OpenAI and data centers. He even said he was crying over having to sell those NVIDIA shares.
That's an amazing detail. It shows the conviction.
And the pressure, right. He vehemently rejects the bubble idea, arguing that anyone who talks about an AI bubble is not smart enough. He predicts that super AI will eventually add a staggering 10% to global GDP.
That is a huge forecast. But the question is, are we valued for that future or for right now? Okay, let's pivot to the global policy and legal battles that will shape profitability no matter what the tech does.
And the tariff dispute has reached a really high-stakes legal juncture, and it involves Costco.
The retail giant.
The retail giant filed a lawsuit against the administration asking for a full refund of these reciprocal and fentanyl tariffs it has paid.
And the core issue here is massive. I mean, it's potentially destabilizing for presidential power. It's now before the Supreme Court.
The question is, did the president have the legal authority under the International Emergency Economic Powers Act, the IEPA, to just unilaterally impose these duties?
When Congress holds the constitutional power to impose tariffs,
that's the heart of it. And this case is incredibly time-sensitive. I was reading in CNBC, Costco's suit is focused on a looming December 15th liquidation deadline.
so what happens on that deadline?
If the Supreme Court rules the tariffs illegal after that deadline, the company is worried the government will be legally shielded from having to refund the tariffs they've already paid. So they're rushing to court to protect their past financial exposure.
And skepticism over tariffs, it isn't just coming from retailers. Even Elon Musk, despite his warming relationship with the administration, told CNBC he tried to talk the president out of using tariffs.
Arguing they, quote, distort the markets.
And that free trade is just a better economic structure.
And that view is supported by recent data. Yahoo Finance reported that U.S. manufacturing contracted for the 9th straight month in November, and factory managers are linking layoffs directly to the drag from import tariffs.
We did see some offsetting global trade updates, though. The U.S. and U.K. agreed to a zero-tariff deal on pharma products.
A lot of horse trading happening behind the scenes. Let's shift to regulatory pressures in Europe, specifically on Apple's App Store.
Right. They were refused permission to appeal a UK ruling on commissions, and now they're facing a critical decision from the EU's top court.
The CJEU, yes. And the ruling here sets a really important precedent. The court ruled that Apple can be sued in a Dutch court by two foundations, even though Apple argued the harmful event didn't happen in the Netherlands.
So how did the court justify that?
They ruled that because the App Store was specifically designed for the Dutch market, using the Dutch language, Dutch Apple IDs, local currency, the damage can therefore occur in that territory.
Wow. That's a huge win for local regulators asserting their jurisdiction over global tech giants.
It is.
And before we get to the macro polls, let's quickly note a positive legal development for Bayer. Shares popped 11% in Europe, according to CNBC.
Yes, after the administration backed curbing U.S. litigation related to the Roundup weed killer. The Solicitor General is urging the Supreme Court to limit state law claims against the company.
A huge potential victory for them, given how depressed that stock has been by all these lawsuits.
It could significantly reduce their future legal exposure.
Finally, let's look at the macro pulse. Inflation, central bank stability, and how the U.S. really stands apart.
The latest data out of the Eurozone just shows stability. Inflation edged up slightly to 2.2% in November, just a shade above the ECB's 2% target.
In core inflation,
Held steady at 2.4%. Services inflation was the highest component at 3.5%.
that sounds like a textbook definition of stable, just a little hot.
It does. And this reinforces the European Central Bank's comfort level. The key deposit rate remains at 2%. Christine Lagarde said rates are set correctly. Bloomberg is reporting that markets are now pricing in stability, with no rate moves expected through 2026. Their job seems a lot easier than the Fed's right now.
Well, contrast that with the U.S. rate expectation. Despite the market slide on Monday, expectations for a U.S. Fed rate cut are aggressively high.
Very high.
Yahoo Finance notes that markets are pricing in an 87% chance of a quarter-point cut at the December 10th meeting. The U.S. market is demanding stimulus.
While the Eurozone seems content, that divergence is something you really need to watch. It raises the question of whether the U.S. market's expectations are, realistic.
So as we wrap up this deep dive, let's just recap the most critical takeaways. We saw the institutional adoption of crypto conflicting sharply with the immediate implosion of those leveraged MicroStrategy ETFs. The AI chip wars led by NVIDIA's shift, threatening to raise the cost of your future tech by up to 10%. And these major legal battles defining corporate risk, from Costco's tariff lawsuit to Apple's antitrust exposure in Europe.
And the broader context for all this is crucial. The OECD actually upgraded global growth forecasts this week. They noted that massive AI investment is helping to offset some of the drag from tariffs, but that optimism comes with a serious, serious caution. If the earnings of AI companies fail to meet the market's exceptionally high expectations, that FOMO we talked about,
It could trigger a severe correction.
a severe stock market correction.
Yeah.
So how much of this massive tech rally, the real driving force of recent market gains, is true substance? And how much is pure forward-looking optimism that could just, quickly turn into panic? That's the core question you need to keep asking as you navigate the final weeks of the year.
A critical question indeed. Thank you for joining us on this deep dive.
Yeah.
We'll see you all tomorrow morning with new headlines from major financial magazines.